Thank you for joining this morning's webinar. We're going to go over your questions. We're also going to talk about the solo 401k eligibility requirements. We're going to talk about the pre-tax solo 401k distribution as well as contribution rules versus the Roth solo 401k plan. You can always follow the conversation on our community, which is my solo401k.net/my community. And we're live here every day at 10 a.m. Pacific time, Monday through Friday. We'll be on live again today at 1 p.m. Pacific time. On our community, you can follow the conversation. All are free to join, whether you're a client or not. It's free to join the community, where we have over 30,000 members. There are hundreds of forum posts out there, video, with a large video library, a section for guest blog posts. So feel free to post a guest blog out there. A lot of financial professionals post blogs out there and then link back to their business. So it's a good way to get information out about your business as well. All right, so as always, today's presentation is for informational purposes. We're not providing investment advice, nor are we selling investments, nor are we providing tax advice. All right, so the solo 401k plan, you have to be eligible to open one. In order to be eligible, you have to meet certain requirements. One is you have to have a self-employed business where you are an employee in that business as well as an owner in that business. So for instance, it can be a sole proprietorship where you're a contractor, so you file a Schedule C. So that means you're self-employed. You cannot employ any non-owner common law W-2 employees in any of your businesses. So if you want to open a solo 401k plan and you own multiple businesses, you're going to have to determine whether or not any of your self-employed businesses have any full-time non-owner W-2 employees, which is defined as a non-owner common law employee who works 1,000 hours or more. If that's the case, then you would not qualify to open a solo 401k plan. Your spouse can also participate in the plan as long as he or she is also working in the business. That's why oftentimes you'll hear terminology of spouse solo 401k, a solo 401k for both spouses. Here's an example of a one participant plan. Let's say that you're a contractor, so you file a Schedule C, or maybe you have a single owner S corporation where you're the only owner and the employee. So the solo 401k plan would be sponsored by your name if we're talking about a sole proprietorship. If we're talking about an S corporation, then the S corporation would sponsor the solo 401k plan, and you are a participant in the plan. That's why you're going to see two separate holding accounts here on this slide, because you are required to segregate each source of funds. That is pre-tax funds, Roth funds, and voluntary after-tax funds. Therefore, it's just one plan with three separate bank or brokerage accounts, that is holding accounts to hold funds. The plan that we provide is already built to allow for all these contribution types. So you're not required to make all these contributions right away. You can make them later or never, but the plan is already built to allow for these contribution types. In some years, we have clients that solely make voluntary after-tax solo 401k contributions up to the overall limit, which is $69,000 for 2024 and $70,000 for 2025. And then they'll immediately convert it to the Roth solo 401k. That's why it's called the Mega Backdoor Roth solo 401k. Here's an example of a two-participant plan, where both spouses participate in the plan. So here, instead of three separate holding accounts, it's going to be a total of six. So let's say self-employed business is an LLC, and both spouses are working in that LLC. So the LLC sponsors the plan. Each spouse is a participant, so 3 separate holding accounts for each spouse for a total of 6. So pre-tax Roth and voluntary after-tax. Because you're required to not only separately track each source of funds, but each participant's funds also have to be separately tracked, and that's accomplished by opening up separate bank and or brokerage accounts under the plan. Okay, let's take a look at a question here, and then we'll come back to some more slides here. So I have filed my 2024 tax. I have not filed my 2024 taxes yet. I am not 100% sure what my accountant is going to select. LLC taxes, S corp, or a sole proprietorship. What should I elect in the solo 401k application? That's a great question. So you need to hammer that out, whether it's going to be taxed as a sole prop or as an S corporation or even as a partnership. I can tell you that it's generally best if it's taxed as an S corporation from the contribution perspective, because it's going to take less W-2 weight from that self-employed LLC to contribute. Whereas if it's taxed as a sole prop, you're going to have to report more Schedule C, line 31, self-employment income. So bottom line is you need to get with your CPA before you complete the online application and get started. Also, the rules are a little bit different too. If we're talking about an LLC tax as a sole proprietorship, especially in your case, if you're trying to make contributions to the plan for 2024. If you have an LLC tax as a sole proprietorship, for example, or if it's just set up as a sole proprietorship, you're going to be able to make employee contributions for 2024 by April 15 of this year. So you'll be able to open that solo 401k plan by April 15 and make contributions by April 15 for 2024. Whereas if it's an LLC tax as an S corporation, you're only going to be able to make employer contributions and voluntary after-tax contributions for 2024 because the plan had to be set up by December 31st of 2024 in order to be able to make employee contributions this year for 2024 by your business tax return due date plus timely filed extension. All right, so that might be your answer there. You might want to have a tax sole proprietorship if you're trying to make employee contributions for 2024. If you're not planning to make employee contributions for 2024, and let's say, for example, you're trying to maximize your voluntary after-tax contributions, then LLC taxes and S corp would be ideal. Okay, we'll come back to some more questions here. Let's keep going here. So if you're looking to open a solo 401k plan for the first time, we make it easy. We have an online application where we collect the necessary information to draft the plan documents, which are generally drafted the same day and provided by a download link. And then you sign and you upload them. And then you reply to a next step questionnaire, which lets us know whether you want to use bank or brokerage accounts to hold the funds. We can help you open those up. And then we'll provide you with the necessary information to help you open up the bank or brokerage accounts. And after that, you can fund it by making annual contributions or also by transferring IRAs and former employer plans. Well, here are some things to consider when opening a solo 401k plan. The number of participants that will be in the plan. For example, if both spouses are working for the business, then both can participate in the plan. Whether it be a 2-participant plan, whether you're going to make Roth contributions, voluntary after-tax contributions, pre-tax contributions, whether you want to hold the funds in a bank or a brokerage account, the types of investments you want to make, voting where you want to hold the funds. Most of our clients will hold the funds over at Fidelity or Schwab. The reason being is one-stop shop, meaning that you're going to be able to invest in equities as well as alternative investments like real estate, promissory notes, precious metals, and so forth. Again, you can transfer former employer plans to the solo 401k plan as well as traditional IRAs. However, you cannot transfer a Roth IRA to a solo 401k plan. That's a Roth IRA restriction. You can, of course, transfer a former employer Roth 401k or a 403b Roth or 403b thrift savings plan and so forth. All right, let's take a look at a couple more questions here, then we'll circle back to the eligibility requirements and we'll continue talking about pre-tax solo 401k versus Roth solo 401k. So here's a question here. I opened a solo 401k 3 years ago. I am 65, will work in 2025, and plan to retire. I have 2 investments in real estate, limited partnerships, which I will likely run another 7 to 10 years. Can I retire, have no income in the sole proprietorship, and keep the solo 401k in place until the limited partnerships are finalized? That's a great question. And we get this question quite a bit, as a matter of fact, especially um, as our book of clients um, materializes into the years. We've been in business for quite a while, so we have a lot of clients going all the way back to 2009. But to answer your question, the general expectation from the government is that once you know that you're going to permanently cease employment activity, that the plan should be shut down and transferred to an IRA. So permanently generally means that you may be doing self-employment activity, at least on a part-time basis. You're not required to make contributions to the plan. That doesn't mean you're not doing self-employment activity. You're doing material services. You've just chosen not to contribute to the plan. Under that type of scenario, you could continue with the plan. Another scenario is where 1 year you might do some self-employment activity, the next year you may not. Well, you could still continue with the plan. An example of no longer doing self-employment activity permanently would be, let's say that for 2 consecutive years or more, you stop doing self-employment activity. That's an example of where the expectation from the government would be to shut the plan down. There's also another kind of murky scenario where generally applies to individuals who have met retirement age. So obviously someone who is 65 or over retirement age. So one option under that scenario is you could freeze the solo 401k plan, which means you're not going to be able to contribute to it anymore. However, that's a little murky because even though you decide to freeze the solo 401k plan, if you no longer have a self-employed business, then technically, how are you going to be able to continue with this 401k plan? So that whole freeze piece is generally reserved more for traditional 401k plans, full-time employer plans. Let's say you have a 401k through Microsoft, and obviously you're not an owner of Microsoft, but rather a participant in the Microsoft 401k plan, and then you stop being self-employed, or excuse me, you stop working as a W-2 for Microsoft. Well, Microsoft is not going to shut down. They're still going to, the business is going to be open. However, you as a participant can keep your funds there because there's a business tied to that Microsoft 401k. Well, with the solo 401k plan, especially if we're talking about a sole proprietorship, if you're no longer doing self-employment activity, then how can you have a business sponsoring solo 401k plan? So in short, it's a little murky. From a conservative perspective, it would be best to close the plan down once you permanently cease self-employment activity. And you can actually transfer those alternative investments, whether it's real estate or in your case, private investments, those could be transferred to a self-directed IRA through an in-kind transfer, where the limited partnerships would be assigned to that self-directed IRA. We would then issue a Form 1099-R to report a non-taxable in-kind transfer from the solo 401k to that self-directed IRA, and then file a final Form 5500 easy which applies regardless of market value when a plan is being shut down. All right, let's look at some more slides here and we'll come back to some more questions. So let's look at the solo 401k eligibility perspective for those who are looking to open a solo 401k for the first time. So any entity type could sponsor a solo 401k, meaning that it doesn't have to be a formal entity such as a limited liability company or an S corporation. It can be a sole proprietorship where you're a contractor and you file Schedule C, or let's say you're a farmer, you would file Schedule. So it's not the entity type that determines whether or not you're self-employed. It's rather the actual activity, doing the material work, the material services. So you have to be doing work, material services as a self-employed individual in order to qualify to open a solo 401k plan. You can learn more about those solo 401k eligibility requirements by reading IRS publication number 560. That's the publication for self-employed plans, whether it's a SEP IRA, simple IRA, solo 401k, or the farm benefit plan. We talked about how your spouse can also participate in the plan if he or she is also working in the business. You can also contribute to a solo 401k plan while also contributing to your daytime employer 401k. Of course, in order to contribute to a solo 401k plan, you have to be self-employed. Contributions would be based on your net self-employment income, not your daytime job income. You're contributing to the solo 401k plan. You are going to need a separate employer identification number for the 401k because the 401k is a retirement trust. Therefore, you cannot use your social security number or your business EIN. And that self-directed solo 401k employer identification number is going to be used when opening up the bank and or brokerage accounts, as well as performing 1099-R reporting for distributions, conversions, as well as the mega backdoor Roth solo 401k strategy. Okay, let's switch gears to the comparing the Roth solo 401k versus the pre-tax solo 401k. So when we're talking about, let's talk about it from the contribution side of things first. So with the Roth solo 401k, you can make employee Roth solo 401k contributions as well as employer Roth solo 401k contributions. However, with a pre-tax solo 401k, you can also make employee pre-tax solo 401k contributions as well as employee Roth solo 401k contributions. See if I can share a screen here and provide some more guidance on that. There we go. So here's a good slide here regarding contribution types. So again, we're talking about a pre-tax solo 401k versus a Roth solo 401k from a contribution perspective. So employee contributions, those can be made by a Roth employee solo 401k contributions or pre-tax employee contributions. Now, if we're talking about employer contributions, those typically have to be made as employer pre-tax contributions. So let's say that your self-employed business is a S corporation, that would be that 25% of W-2 wages. On the other hand, if your self-employed business is a sole proprietorship, that would be 20% of your line 31 Schedule C. Well, now you can also do employer Roth solo 401k contributions, in addition to employer pre-tax contributions. And that's because of Secure Act 2.0. That's the act that now allows employer Roth solo 401k contributions. So let's go back to the contribution limits here. Give me a moment here. We're looking at the contribution limits, and let's talk about the employee side of contributions, and then we'll talk about the employer side of contributions. So looking at 2025 numbers, let's say you want to make a Roth solo 401k employee contribution. You could contribute 23,500 as a Roth employee solo 401k contribution. And let's say you also want to make employer Roth solo 401k contributions. Well, that's a percentage. And here we're coming up with 46,500 because if you add these two amounts together, it should take you to the overall limit, which is $70,000 for 2025. In other words, you can't contribute more than $70,000 in all solo 401k contributions. So under that example there, this is an individual that has decided to make an employee Roth solo 401k contribution and an employer Roth solo 401k contribution, and they get to that 70,000 overall limit. Now let's muddy up the waters a little bit more. As you can see, all these contribution rules are really all over the map. So luckily we work with these every day. So that's why we provide support in these daily webinars, because it's a lot of things to remember. Well, let's muddy it up a little bit more by talking about the voluntary after tax, not the voluntary, the catch-up contributions. So catch-up contributions are for those who are age 50 or older. Now, those are always going to be considered employee contributions, and you can apply them as an employee Roth solo 401k contribution or as a pre-tax employee solo 401k contribution. So on top of these two amounts here we just talked about, that 23,500 and that 46,500, you can also do a catch-up contribution of $7,500 if you're age 50 or older. And you can treat that as a Roth employee solo 401k catch-up contribution. Now your overall limit goes up to $77,500. Now for 2025, resulting from Secure Act 2.0, you can also do a super catch-up contribution of $11,250. But it only applies to a certain age group, which is anyone who's age 60, 61, 62, or 63 here in 2025 by the end of the year. So if you fall under that category, instead of doing $7,500, you can make an $11,250 catch-up contribution, and that would be applied as an employee Roth solo 401k catch-up contribution, because again, employer contributions cannot be applied as catch-up. Same is true for voluntary after-tax solo 401k contributions, which I don't want to get into right now because they're really muddy up the waters. So those are some important differences between the pre-tax solo 401k and the Roth solo 401k from the contribution perspective. Okay, let's look at some more questions here and we'll come back to some more slides here. So here's a question from Catherine. I'm trying to make a backdoor Roth solo 401k. I want to clarify because my CPA is confused. Well, with all due respect, we find out that a lot of CPAs are confused because they just go to college to study 401k plans. I mean, the solo 401k plan, not all CPAs and professionals really understand them. That's why they generally work with a company like ourselves that really hones in on solo 401k plans. And we've been doing this since 2009. I myself have been in the industry since the middle of the 90s. So I've been privileged to see all that goes on, even since the Roth IRA was first offered back in 1998? And of course, the solo 401k became popular back in 2001. And then the mega backdoor strategy really became popular in 2014. But not to get off track here, let's keep looking at your question here. The business does not receive a tax deduction if they make a non-deductible after-tax contribution. That's correct. So that's the thing about voluntary after-tax solo 401k contributions. It's a strategy to get more Roth solo 401k money indirectly. Because as we talked about a little bit earlier, well, I mean, the slide's actually still there. The Roth solo contribution limits are a lot less than the backdoor voluntary after-tax contributions, but no, you don't get a deduction. So essentially trading, taking a deduction now versus converting those funds to the Roth solo or Roth IRA with the expectation that it's going to grow tremendously as you make a good investment. So of course, it's going to depend on how well you invest those funds, but if they grow astronomically, then those would be considered tax-free when you make distributions. So you're trading, taking a tax deduction now versus tax-free growth down the road once you convert those voluntary after-tax solo 401k contributions to the Roth solo 401k or to the Roth IRA. But yeah, as soon as you convert those voluntary after-tax solo 401k contributions to the Roth solo 401k, you can do it right away. You don't have to wait a certain amount of time. You want to do it right away so that there are no earnings because it's a non-taxable conversion. So you convert it immediately to the Roth solo 401k or Roth IRA. You got to convert everything that's inside that voluntary after-tax solo 401k bucket. Typically, there might be small gains, like let's say a few dollars or $50. That would get converted as well, and that $50 will be taxable, but the other 70,000 is not taxable. So very minimal taxes are triggered. But it does need to be reported on a Form 1099-R. And we take care of that for clients who timely request that. We'll file a Form 1099-R with the government and provide you with a copy. Okay, good question. Let's keep going here and then we'll come back for some more questions here. So we're starting out Friday with a bang here. Keep in mind, we're also going to be back here at 1 p.m. Pacific time today. We're actually going to be talking about contribution rules there for a sole proprietorship for 2025 and 2024. We did one last Friday that concentrated on the S corporation contribution rules, and we posted it on our website. Okay, so we talked about the pre-tax solo 401k versus the Roth solo 401k from a contribution perspective. Let's talk about it now from a distribution perspective. Pull up that information here. So let's see here. Let me get to my screen here that I want to share. Okay, so from a distribution perspective, when comparing pre-tax solo 401k funds versus Roth solo 401k funds, the rules are similar, but they're still different in some regards. Um, let's talk first about pre-tax solo 401k distribution. So in order to make a distribution from a pre-tax solo 401k, you have to meet certain triggering events. The triggering events typically are age 59 and a half or older, or no self-employed. Those are the typical triggering events. Now, there's also subcategories to look at. Let's look at salary deferrals, also known as employee contributions. So let's say you make an annual contribution to your solo 401k plan and you want to take a distribution of those funds. So that would be a taxable distribution. Well, in order to take that distribution from that contribution, you're going to have to be either age 59 and a half or no longer self-employed. Of course, you can also take it on account of a hardship, such as an overdue electric bill or you're going to be evicted for late rental payment. So it's got to be those type of hardships or overdue medical bill. I don't want to talk too much about hardships. That's really a whole different daily webinar we're going to do on that. But if we're talking about pre-tax employee solo 401k contributions, you generally have to be 59.5 or no longer self-employed in order to make a distribution. Now, if you transfer pre-tax IRA funds and pre-tax former employer plan funds to the solo 401k plan, however, those can be distributed at any time. So let's say, for example, that you're age 49 and you open the solo 401k plan and you transfer your traditional IRA to the solo 401k plan. You're going to be able to distribute those funds from the solo 401k plan because they're coming over from an IRA, or let's say they came over from an employer pre-tax 401k. So you don't have to meet that triggering event of age 59.5 or no longer self-employed to take a distribution of pre-tax solo 401k funds that were transferred from a former employer or from an IRA. You, of course, are going to have to pay federal taxes, depending on your state of residence, state taxes, and that 10% penalty. So it's not ideal to make a distribution from your pre-tax solo 401k if you can keep doing so. Now let's talk about making distributions from your Roth solo 401k. Let me pull up some slides on that. So from a distribution perspective, again, talking about Roth solo 401k funds. So there are two types of distributions that can be made from a Roth solo 401k plan. It's either going to be a qualified distribution or a non-qualified distribution. And that non-qualified versus qualified has to be more with respect to having to pay taxes. Roth solo 401k funds grow tax-free, and then you can later distribute those tax-free, providing you meet certain rules, which are qualified Roth solo 401k distribution rules. So what is a qualified Roth solo 401k distribution? Well, as we discussed earlier, the solo 401k plan allows for Roth solo 401k funds and pre-tax solo 401k funds. Remember we talked about how you are required to separately track each source of funds by opening up separate holding accounts, that is bank or brokerage accounts for each source of funds and for each participant. So if it's a one participant plan, that's going to be three separate buckets. One to hold the pre-tax solo 401k funds, the second one to hold the Roth solo 401k funds, and the third one to hold the voluntary after-tax solo 401k funds. So holding in on the Roth solo 401k bucket, if you want to distribute funds from that Roth solo 401k plan and you want it to be a qualified distribution, meaning it's not going to be subject to any federal taxes or state taxes on those gains, then you're going to have to meet two requirements. The first one is you have to have had funds in that Roth solo 401k bucket, so they'll hold an account for at least 5 years. And you have to be age 59.5 or older. So if let's say you're age 61 and you open a solo 401k this year in 2025 and make a Roth solo 401k contribution to it, you will have already met that age 51.5 requirement, or the first requirement. However, you're going to have to wait 5 years because you also have to meet that 5-year rule where you've had the funds in the Roth solo 401k for 5 years. So that's what a qualified distribution is. A non-qualified distribution is one where first you have to be age 59.5 qualified to make the distribution. Because remember, a triggering event to make a distribution from a solo 401k, whether we're talking about pre-tax solo 401k funds or Roth Solo 401k contributions is that you have to be age 59 and a half. Now, it's going to be a non-qualified distribution from a tax perspective, which means that you're going to have to pay taxes on the earnings, but not the basis. So if you haven't had the account for 5 years, then you're going to have to pay taxes on those gains. And what is more, unlike a Roth IRA where you can take distributions from the contributions first, you've got what's called the Roth IRA order distribution rules. With the Roth Solo 401k, it's different. When you make a distribution from a Roth Solo 401k, you have to take some from the gains, so the basis, and some from the earnings. So if you do a non-qualified distribution, you end up having to pay taxes on those gains, whatever that amount is, plus state tax. You have to pay federal taxes and possibly state taxes. Okay, so those are the major differences between pre-tax solo 401k and Roth Solo 401k distributions. We covered the contribution differences about 10 minutes ago. Let's look at some questions here, and then we'll keep going here. So, all right. And now, if your CPA has questions about your plan, you can certainly have your CPA send us an email, or you send us an email and copy your CPA, because we're not going to communicate with him or her without your approval. You can also schedule a call where we can do a conference call with your CPA if he or she has questions about contributions. All right, let's take a look at some more questions here. Um, Here's a question here, interesting. I currently have a holding Wyoming LLC that owns a Florida limited liability company that has a few properties under it. Should I open a solo 401k under the Wyoming LLC? Well, number one, you have to be self-employed to open a solo 401k plan. So if you're saying that your LLC, you're doing material services where you're actually doing the work and you're reporting that as taxable earned income to the IRS, then you might qualify for a solo plan. So you got to be working in that business, doing work in material services, and you got to pay yourself and report that as earned income. It cannot be Schedule E income or investment income. That's a very good question. So anytime you are looking to set up a solo 401k plan, you have to understand that it's for self-employed individuals who are doing material services. It's not for investment income. So if you have let's say you own some properties through your LLC and they're just passive, meaning you're hands off where you're not doing any of the work and not reporting it as taxable earned income to the IRS, then that would not qualify. As far as which LLC to use to open a solo 401k plan, you're going to ask the individual that put that Wyoming LLC for you, because a lot of times those are put together more for investment purposes, not for self-employment activity purposes. So that's going to be a good question for that individual. But simply stated, if you're a sole proprietorship or if you have an LLC where you're doing the work, then that LLC would be your self-employed business, and the solo 401k would be set up or sponsored by that LLC. All right, here's another question here. I'm not happy with my solo 401k provider and wish to change to another provider. I have a crypto custodial account. How do I transfer your plan, or do I need to liquidate the position? Thank you. Great question. So anytime you change from one provider to another provider, that's known as a restatement. And we're going to have to dissect exactly who your solo 401k provider is. If it's a self-directed 401k provider, that means that typically you already have the employee identification number for the plan. You already have the plan name, obviously. You already have bank or brokerage accounts for the plan. So that might make it pretty simple with regards to a restatement, where you would fill out our online application, we would draft new plan documents so that you fall under our new plan documents, and then You can keep the same plan name, same holding accounts, same crypto account. So that would be a very clean break. Now you would fall under our plan, so we would be the ones providing compliance support. We would be the plan provider, and then you can communicate to the current provider that you've switched providers. So send us an email if you want to explore it further. Send it to business@mysolo401k.net. But yes, we restate a lot of plans from other competitors as well as from traditional firms like Fidelity and Schwab, if you have a solo 401k there. Okay, let's look at another question here. I currently own a business and also have a full-time W-2 job. Do I select yes or no under application questions? Are you currently participating in a self-employed plan? Good question. You're going to say no because you currently don't have a self-employed solo 401k plan. You've got a daytime 401k with your daytime employer. The answer is no. Okay. As far as address, well, enter the application. No, it's not public. Another question here. Are all 401k transferable? Are there exclusions? Can I transfer all of my former employer funds to my new solo 401k? Question. So yes, you can transfer all former employer 401k plans. Solo 401k plan. Same is true for former employer 403b, thrift savings plans, governmental 457 plans, simple IRAs. The solo 401k is often used to consolidate retirement accounts. Let me share that slide I shared earlier about that. Find it here. Here's a good slide here where we talked about transfers. So all these types of accounts, so a solo 401k is used to consolidate retirement accounts as well. Okay, let's see what other question we have here. Good question. Doesn't matter what type of name you name your solo 401k. No, generally you want to not include the words 401k in the name, anonymity, especially if you're placing alternative investments. But if the Fish's name can be used, like let's say Pine Trees Trust, you want to add the word trust after the name. Typically, you want to keep it 3 words that include the word trust, so Pine Trees Trust, because keep in mind that name will be used going forward for all reporting, and it's going to be important in replacing investments as well. Um, let's see here. What else do we have here? So we got another question here from Catherine. My CPA says that the employer can make non-deductible contributions. We need to see the detailed information on this and get a better understanding. I would like to have the technical information from the TPA to review because we have not seen this in practice yet. If it doesn't make sense to me, that the business would not deduct the employer contribution because this could create. Okay, so I think this question here has to do with employer wrongful 401k contributions that we were talking about earlier. So employer Roth solo 401k contributions is a new contribution type that I talked about earlier that stems from Secure Act 2.0, where you can make employer Roth solo 401k contributions, which are going to be deductible on the tax return of the business. So let's say it's an S corporation, that employer Roth solo 401k contribution would be deducted on that Form 1120S. But then it's going to be treated as a taxable conversion. So that's one of the things about making Roth employer solo 401k contributions is that yes, you get a deduction on your employer side, but then you're going to have to pay taxes because then it's treated as an in-plan pre-tax conversion. So we've done webinars on that. That's a whole other webinar. If you send us an email, we'll gladly send you more information, but let me send you some links from our website to talk about employer Roth solo 401k contributions. Um, Give me a moment here. So let me share some good info with you right now. Okay, take a look at the link I just shared there with you. Let's talk, let's see the other link here. Employer, one moment here. Here's a good one here. This will be good for your CPA. Share with your CPA about employer Roth solo 401k contributions. As you can see, we have more than enough resources on our website. And your CPA can go out there and search our website. So here's a great one here for you about making employer Roth solo 401k contributions. And I'm also going to send one last one here. So even though, where is it at? Let me find that last one I'm going to share with you here. Employer Roth solo. I can find it here. Oh, here we go. This is a good one here that kind of talks about there's really no substantive advantage of making employer Roth solo 401k contributions. It's one of those things that sounds great on the surface, but then as you start reading into it, you scratch your head and you're like, okay, why are why are people talking about employer Roth solo 401k contributions so much? Make it sound like it's the best thing since sliced bread. Okay, so here's another one that you can look at as well that we did. So take a look at plenty of stuff here. So take a look at that, please. Um, let's go over some more slides here, and then we'll come back and look at some more questions. So contribution limits or contribution deadlines, I should say. There's a good slide for the 2024 employee and employer contribution deadlines. So if you have a solo 401k plan already with this, then you have plenty of time to make employee and employer contributions here in 2025 for 2024. And this slide here breaks down each entity type. So for example, for a sole proprietorship, you have until April 15th of 2025 to make those employee and employer contributions for 2024. If you file for an extension, you're going to have until September 15th of 2025. As corporation, you have until March 17th of 2025 to make employee and employer contributions for 2024. And you have an extended deadline of September 15th of 2025 to file a business tax return extension. This slide here is for 2025 contributions. Obviously, you have plenty of time. You have until next year in 2026 by the business tax return due date to make employee and employer contributions. We have these listed on our website on the contribution page as well. So take a look at that. Let's look at a few more items here. Let's talk about the solo 401k auto contribution credit. That's a good one. Let me share my screen here. Before we do that, let's talk about, look at some questions here. There are a lot of great questions here today. We appreciate you joining. Again, we're live every day, Monday through Friday at 10 a.m. Pacific time, and then a second time at 1 p.m. Pacific time. So we'll be back here in a couple hours. Look at another question here. Let's see here. Let's see. Thank you. It's more simple to just do a mega backdoor instead. That's exactly right. And it's Simple, because with the mega backdoor Roth solo 401k contribution, if you're talking about an S corporation, that's dollar for dollar. It's not percentage based. So for instance, if you report a minimum of $70,000 of W-2 wages for your self-employed S corporation, you report that on a W-2 box one, you're going to be able to contribute that entire $70,000 to the voluntary after-tax solo 401k plan, and then turn around and convert it to the Roth solo 401k plan. So here you would make it let's see here, into the voluntary after-tax bucket here, so $70,000. And then what you would turn around and immediately convert it to the Roth solo 401k plan. Whereas if you try to do it as an employer Roth solo 401k contribution, you can only do 25% of that $70,000. So it takes less money to get that $70,000 in your Roth solo 401k than it does by doing an employer Roth solo 401k contribution. Okay, so let's finish going over some slides here, and we'll come back and answer some more questions here. Let me share my screen here. Um, okay, so the solo 401k plan also allows for the auto contribution credit, which is $1,500. And that applies to anyone that opens a solo 401k plan here in 2025. The plan documents is going to have that $1,500 auto contribution credit built into it, which means you're going to be able to deduct $500 in your business tax return over a 3-year period for a total of $1,500. That is the auto contribution credit. Traditional plan providers like Fidelity and Schwab, Ascensus, Payroll Price, and so forth don't offer, even ADP, don't offer a solo 401k plan that has the auto contribution credit built into it. It really did not become available until April of 2023. So if you're an existing client from the middle of December of 2023 and prior, your plan can be amended to add this auto contribution credit that can be added this year, and you're going to qualify to get a $500 deduction, dollar for dollar, over a 3-year period for a total of $1,500. And it essentially, you're going to file Form 8881 each year, this form here. You're going to file that Form 8881 each year to get that $500 auto contribution credit. So this year in 2025, if you open a plan, for instance, or if you add it to your existing plan, then this would be the first year. So $500 for 2025, you would file Form 8881, and a second amount in 2025, and excuse me, a second amount in 2026 for $500. You would file another Form 8881 at that time, and then a final one of $500 in 2027, you would file Form 8881. Okay, let's finish up here, and then we're going to look at some more questions for this morning, but we'll be back again today, as I mentioned earlier. Let me find the slide I'm going to talk about here. Okay, let's talk about reporting requirements for your solo 401k plan. This applies whether you have pre-tax solo 401k funds or just raw solo 401k funds, or you have both within the plan. So our annual fee for being this is $125 for being the solo 401k plan provider. We also include in that annual fee any type of preparation for compliance reporting such as Form 1099-R and Form 5500 Easy. Uh, Form 5500 Easy applies to solo 401k plans once the market value of the plan is greater than $250,000 as of the end of the plan year. To determine that 250,000 greater value, you have to look at all the funds in the plan. So let's say you have Roth, pre-tax, and after-tax funds in your plan. You have to add those all together. And also, you have to include investments. So your equity investments, your alternative investments, you have to add all those amounts together. And when added together, if the value is greater than 250,000, it's going to trigger having to file Form 5500 easy, which is an informational return. Likewise, if you have a solo 401k plan with two participants, let's say both spouses participate in the plan, where they're both working for the same self-employed business, you have to look at both of their balances in the plan and add all those together. And then if that, because remember, the value of the plan is determined at the plan level. 5,500 is for the plan. So you have to add all the participants' funds and investments to see if it's met that greater than $250,000 threshold. For example, if you are a client, your plan year ended December 31st of 2024, and the value of that plan is greater than 250,000, a Form 5500 easy needs to be filed with the government by July 31st of this year. Again, we'll file that for our clients who timely request it. So, because we don't have access to our clients' funds, we don't have no idea whether or not you need that 5500 easily completed. So you need to communicate with us as the trustee of the plan. Let us know. So this slide here talks about that. Okay. Another reporting requirement that I touched on is the Form 1099-R. We'll also hand it out for our clients who timely request that form. Now, Form 1099-R applies when you process a distribution from the solo 401k plan. So it's not for contributions, but for distributions. It also applies whether you're making a distribution from your pre-tax solo 401k or the Roth solo 401k plan. Same thing for conversions. If you do a mega backdoor Roth solo 401k conversion, where you convert voluntary after-tax solo 401k funds to the Roth solo 401k or to a Roth IRA, that's going to trigger the requirement to file a Form 1099-R. Whether or not that conversion is taxable or not, it still needs to be reported to Uncle Sam on that Form 1099-R. And again, for clients who timely request that, we'll gladly prepare that. Same thing for required minimum distribution. Once you reach age 73, you are required to start making distributions from your solo 401k plan. Of course, it doesn't apply to Roth solo 401k funds. That's one of the other differences between a pre-tax solo 401k and a Roth solo 401k is that with the passage of Secure 2.0, actually Secure 1.0, Secure Act, you no longer have to make distributions from your Roth solo 401k plan. So requirement on distributions no longer apply to Roth solo 401k funds, but they do still apply pre-tax solo 401k funds. So those who are age 73 or older are required to make distributions, requirement on distributions from their pre-tax solo 401k funds. And that needs to be done by the end of the year. So a Form 1099-R would need to be issued. Okay, great. Let's look to see if we have any other questions, and then we'll finish up. Thanks for attending today's webinar, by the way, Q&A session. Here's another question here from Catherine. So is the 70,000 contribution on behalf of the employer or the employee? Good question. It's on behalf of the employee. voluntary after-tax solo 401k contributions are employee. So if you make a $70,000 voluntary after-tax solo 401k contribution, you cannot contribute any more, nor can your employer, because 70,000 is the overall limit. So let's say that you report 100,000 of W-2 wages for your self-employed S corporation, and you decide that you want to make a $70,000, and we're talking about 2025 contribution numbers there, and you want to make a 70,000 voluntary after-tax employee contribution. You're not going to be able to have your employer make an employer contribution as well because you cannot contribute more than $70,000. That's the so normal. Another example is, let's say you report $70,000 of W-2 wages for your self-employed S corporation. And again, we're talking about 2025 contribution figures. You treat that entire $70,000 as a voluntary after-tax solo 401k contribution as part of the mega backdoor, and then you want to convert it to the Roth solo 401k or the Roth IRA. You're not going to contribute any more to the plan, whether employee or employer contributions, because 70,000 is the maximum amount. Another example, let's say you only report $50,000 of W-2 wages for a self-employed business taxes and S corporation. And you contribute the full $50,000 as a voluntary after-tax solo 401k contribution. That's it. You can't contribute any more because you cannot contribute more than you make in W-2 wages. So that $50,000 example, even though it's not, you haven't met that $70,000 contribution limit, you're only reporting $50,000 of W-2 wages. So the employer cannot make a contribution either. Because 50,000 will have been exhausted by you making that 50,000 voluntary after-tax solo contribution. Yeah, we have a lot of fun around here with contributions, especially around this time of year. Okay, here's another question here. Can you provide a link to show steps to convert self-employed tax and solo Roth self-directed 401k because not working at sole proprietorship any longer? Thank you. Um, and solo self. Are you? I'm not quite following here. Are you talking about? Uh, so you're talking about converting from a self-employed S corporation to a sole proprietorship, where you're self-employed now under sole proprietorship? Um, or are you talking about transferring a solo 401k to a self-directed IRA because you're no longer self-employed? I think that's what it is. Because I remember you asked a question earlier about eligibility. So, let me see here. I think that was you. Yeah, so I'll tell you what, send an email to business at my solo 401k.net and we'll send you the procedure for closing a solo 401k plan down once you're no longer self-employed, where you'll be able to transfer that self-directed 401k, including private placement investments to a self-directed IRA as a one-time non-taxable transfer. Okay, let's see here. Um, let's see here. Can we make a pre-tax contribution from the employer and convert it immediately to next 2024 since we can't make the employee deferral anymore? Well, if you're an existing client and you already have a solo 401k plan that you established in 2024 or prior years, you have plenty of time to make both employee and employer contributions. Even for an S corporation, you haven't got your tax return due date, plus time you filed extension here in 2025 to make those 2024 contributions. So yeah, you can make employee contributions and employer contributions. You send over a specific page that talks about that as well. Take a look at this page here. We did a webinar on this last week, actually. Oh, it was established in 2025. So that means that you open the plan here in 2025 by signing the plan document, because the effective date of the plan is determined by the date that you receive and then sign those plan documents. So if you didn't receive plan documents until 2025, and therefore you didn't sign it until 2025, then you can make employer contributions as well as voluntary after-tax contributions. So yes, Secure Act 2.0, excuse me, the Secure Act extended the contribution deadline for employer contributions. So those can be made by your business tax return due date, including extension. So if you're an S corp, you're going to have until September of this year to make 2024 contributions for 2025, both the voluntary after-tax contribution as well as the employer contributions. So keep in mind that the voluntary after-tax solo 401k contributions, those can be made as well by March 15, because we're talking about an S corp here, or by September 15 of this year for 2024. It's employee pre-tax and employee off that where you had to have opened the plan by December 2024. That doesn't apply to voluntary after-tax solo 401k contributions and employer Roth solo 401k contributions, as well as employer pre-tax contributions. All right, everybody, thank you for today's webinar. On for a while here. I've enjoyed it. We'll be back here again at 1 p.m. Pacific time. Until then, make it a great day.